countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The bulls celebrate, the bears commiserate as the S&P looks, maybe, to reclaim its record high. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Shonali Bassick. We're kicking you off to the closing bell here in the United States. We were up, now we're down. We're sort of trying to claw our way back up.
It's kind of tenuous. We'll see if we make it.
Tenuous. Let's take a look at what markets are doing right now. The S&P 500 so close to that record high, about 10 points off. We were up, but then we had that news. President Trump looking to cancel his trade deal with Canada. Now we're down about 0.1%. NASDAQ 100 also down more so 0.2%. Philadelphia's semiconductor index only a few stocks in the green there, and the two-year yield slightly higher, about 2 basis points as we head towards the equity close, Romaine.
Keep an eye on that 61.44 because it's kind of interesting. Even if we don't get there, we're still staring at what is shaping up to be one of the fastest full circle rebounds from a major market drawdown since at least the 1980s. But of course, as always, new record highs brings new scrutiny around the rally's durability. And this time around, there's a lot to scrutinize.
So, while the market is rejoicing at small incremental headlines, I think we need to recognize that the earnings growth that we saw last year is unlikely to be achieved, and these macro and policy headwinds are very much going to be in place over the next few quarters.
And that was Kate Moore speaking with Shonali and Matt Miller earlier today. And the market really did get a reminder just a little while ago, as Shonali alluded to, President Trump saying that he was ending those trade discussions with Canada because of some disagreement over a digital services tax. Now, it's hard to know these days what's real and what's bluster out of the White House. But Bank of America strategist Michael Hartnett, in a note earlier today, he did warn of the risk of a speculative stock market bubble as traders presume that tariff and geopolitical risk is in the rearview mirror. But now we know it is not. We learned that from what Trump just said, and we learned that from the economic data this morning, that while consumer sentiment is improving, it's still weaker than at the start of the year. Furthermore, inflation-adjusted consumer spending, that declined in May for the first time since the start of the year, and personal income slid by the most since 2021. So, Shonali, maybe that's why, as we sort of wait and hope for this record high, there are a lot of questions here about just how narrow that rally has been.
That bubble that you're talking about seems to be only in a few places. Take a look at this. In the yellow, we have the S&P 500. You could see that it's near those new record highs, but you could see that there's a limitation of the breadth that's in the market. This yellow line here shows the percentage of stocks that have hit new 52-week highs. That's only just over 5% of the stocks in the index, and it's relatively low when you look at it compared to the past year. And even if you looked at stocks that are above their 200-day moving average, Romaine, it's only just over half of the index. So you can cut it a few ways, but the question is still, when will most of the index catch up to a small group of gainers, Romaine? It's
a great question, and it's one we kick off to the close with here on this Friday afternoon with Jeff DeGraff, Chairman and Head of Technical Research at Renaissance Macro Research. All right, Jeff, I think this is the parlor game right now. Yeah, a record high, potentially. We can celebrate that, to be sure. But when you look under the hood and you look at the complexion of what actually got us here from those April lows and, of course, coming back all the way to those February highs, does it actually suggest that there's more to come?
I think it does. I know there's concern about narrowness, and certainly that can be warranted. I think you have to get a little bit of room. I mean, today is the first day we've made a 52-week high now in a couple months. And so a lot of times those will kick in a few days or even weeks afterwards. So I think that's important. But, in our momentum work, and I think this shocks a lot of people, it really isn't tech driving things. Tech is part of the beta trade, and tech is certainly, from a beta perspective, driven things. But where we are today is really financials are a big part of that driver. And, financials underlying the strength of the market tend to be a good thing, not a bad thing. I know that there's a bit of a deregulatory bid to those names here. But even with that, if we had some type of looming aggregate demand problem brought about by higher rates or this quest to really tamp down inflation, you'd start seeing that in the financials. And it's just not happening. So I like the fact that financials are at least in the conversation as leadership. In our work, they're actually one of the best areas of the market. So I'm not overly concerned about what's happening in tech. I like that generally cyclicality is holding up better than the defensive areas. That's not true across the board, but certainly certainly there's more for that to go. And the short end of the curve looks like it's in a well-established downtrend for yields. The question remains whether that will translate into 10-year yields or not. And I think that debate is still ongoing and certainly still relevant. We'd like to see yields get down below 4.15 to give us more confirmation or affirmation of that. But certainly the Fed seems to be in the game now versus where we were, say, 4 or 6 weeks ago.
Do you think that's enough for the market to hang its hat on? I mean, we saw the boost in financials. I mean, you were just talking about that. That as a group is at a record high and has had a pretty phenomenal run. Is that a rate story or is there something more to it?
I think it's a combination, to be honest with you. I think it's part of a deregulatory story. I think it's part of a capital requirement story. But keep in mind, and I do think that this is very important, it's a global story. It's not just Goldman Sachs or Morgan Stanley or Bank of America. We're talking about the European banks, we're talking about the Chinese banks, we're talking about the Japanese banks. It's a global story, and I think that is really, really important, that better things, at least as a market seeing them, are ahead for banks and the environment in which banks operate.
I'm also really curious about how people are thinking about quality. We're hearing from investors so much talking about how there's still a lot of fear under the market. You would think that would suggest quality would be something investors are flocking to, except you do have so many retail traders in the market still betting on unprofitable companies and meme stocks. How favorable is quality right now, and do you think it looks something of a cheap ability to buy in this market?
Well, so quality, and I know this sounds counterintuitive, quality isn't that great of a long-term indicator. It happens when there's stress in the system. So quality outperformed, as you would expect, going into those lows of April. Quality in our work got into about the 95th percentile in terms of performance. That to us is usually a red flag, believe it or not, that quality is kind of dominating because people are so concerned. And at the same time, beta was really nowhere to be found. It was in the 0th percentile. So as we've seen this beta rally, which is all the last 2.5 months has really been, you've seen quality come off. And so, look, if you're going to start to see spreads increase, and by spreads I mean something along the lines of BBB spreads to treasuries or something in the credit markets, if you saw financials deteriorate, then I'd expect a bid to come back for quality. Quality doesn't look either cheap or expensive to us here. I think it's just kind of a factor that is being tossed around as the market transitions from a beta move to one that we think is more momentum focused, and it's not the right time to be thinking about quality historically in our work.
Jeff, how do you take what's happening in the bond market and read through what you would do in the equity market? You look at the move in the 2-year over the past week, and since the end of last week, you're looking at a yield that's 15 basis points or so lower. Is that because people are less worried about inflation, or are they more worried about the underlying strength of the economy?
Well, I think right now they're seeing the Fed is on the tape, and they're talking about probably seeing a rate cut sometime in September. So the market's very good at discounting that ahead of time. I think what's most interesting and a little vexing, frankly, is that the real yields, the yields above and beyond what your inflation premium is, are pretty rich here, and that's usually a good sign that people are underweight or underappreciating the value in bonds. So I think there's a compression that can happen as real yields get squeezed out. I think that has something to do with some of this noise that we're seeing around tariffs and about the only lever that the other countries have against us, which is helping to finance our debt. And I think that you've seen that within the currency markets. You've obviously seen it in the fixed income markets, but they've also created this kind of juicy real yield, if you will, that I think they'll start coming back to when some of this nonsense goes away and gets settled. But I think the yields are probably a little artificially high right here, and likely to come in as hopefully some of these negotiations start to cool off.
All right, Jeff, I got to leave it there. Have a wonderful weekend. Jeff DeGraff, Chairman and Head of Technical Research with Renaissance Macro Research, as we continue to keep an eye on the S&P 500 drifting to session lows. This on the back of those headlines that President Donald Trump says whatever negotiations were going on with Canada have ceased, at least for the moment. The Prime Minister of Canada, Mark Carney, weighing in, saying that he will continue to conduct complex negotiations with the U.S., and he says he has not actually spoken to President Trump today. Meanwhile, when we come back here on the big program, we're going to have a fuller breakdown of the economic data this morning, the PCE results, and what the Fed's favorite inflation gauge is signaling about the U.S. economy. Sarah House of Wells Fargo up next.
And from the state of the consumer to the state of our country's biggest banks. Ahead of the bank stress tests out this evening, we're going to discuss the health of U.S. financials. Shares as J.P. Morgan, Goldman Sachs notched fresh records this week, Romaine.
And from the traditional investment world to the alternative investment world, we're going to talk to former NBA executive Bobby Sharma, who set out to start his own firm, Bluestone Equity Partners. That's coming up a little bit later, right here on the big program. Stick with us. This is The Close on Bloomberg.
Now, bond yields are pacing for a sharp weekly decline after a mixed bag of economic data. Inflation-adjusted spending in May falling the most since the start of 2025. Personal income down the most since 2021, despite an uptick in wages, and consumer sentiment hitting a 4-month high in June, despite lingering tariff concerns. Joining us now, Sarah House, senior economist at Wells Fargo. When you take the push-pull, and even today, Sarah, I mean, you looked at the tariff pressures looking like it was about to ease, and then more pressure on Canada put on by the Trump administration. Are you convinced that the tariff pressure is much less of a pressure on inflation at the end of the day?
No, I'm not convinced that the tariff pressure is going to be a lot less than what we were previously expecting. So when you look at today's report in terms of the PCE data, you actually saw another pretty strong print in goods inflation. That's even as we've seen auto prices drop the past couple of months, which we don't think will be sustained. So I think we've really benefited from some softness in services. But when you dig into the components, looking at areas like financial services and insurance, some of the softness in travel, I just don't think it's going to be sustained at those weak rates. So we're still expecting inflation to move back up as we move through the second half of the year.
When you think it's going to move back up, how much higher do you think it's going to get?
Yeah, so we think that we'll see core PCE inflation get to around 3% by the end of this year. And that's coming from some further pickup in goods prices. But also I think it's going to be hard to even maintain the disinflation that we've seen in services. So we've seen in terms of the housing numbers, so those are still trending down somewhat on a year-over-year trend. I think we're getting pretty close to the month-over-month run rate already, though. And as I mentioned previously, I think some of the weakness in travel services, just the degree of softness that we've seen over the past couple months in airfares, hotels, I just don't think we can see those types of declines month in, month out as we move forward. Same thing with the finance and insurance component. So that's closely tied to what's happening in markets, and with equity markets, back near all-time highs, we're going to see that part pick up. So I think we're seeing inflation moving back up towards that roughly 3% number around the fourth quarter of this year in terms of the core.
So with inflation moving back up, I guess the big question is the economy starting to move back down? And if so, is it appropriate to start talking about stagflation?
Yeah, so I think we certainly saw that today. So the consumer fatigue is really front and center now. So the consumer for so long in this cycle has been the stalwart, really keeping the economy chugging along. But between today's spending data, the revisions that we saw to the Q1 spending data yesterday, it really puts that narrative, I think, into question, or at least shows that maybe the consumer isn't quite as resilient. So if you look at through all the ups and downs, strong holiday spending, weak spending early in the year as you had some weather effects, some pull forward in the spring, now some payback here as we head into summer, you've seen real spending is up less than 1% over the past 6 months on an annualized rate. So already beginning to see the sign of the consumer losing steam, and of course being close to 2/3 of the economy, that is contributing to, I think, at least a more stagflationary direction of the economy, even as we're not looking for growth to stagnate outright.
This gets to the question, though, about the health of the labor market and the idea of people, A, staying employed, and more importantly, having some degree of wage growth, at least wage growth that keeps pace, if not outpaces inflation. We get a jobs report next week. It'll be Jobs Thursday instead of Jobs Friday because of the holiday. But I am curious if you are anticipating that we are going to start to see material softness in those monthly jobs reports over the next few months.
Yeah, I think we are set for a further downshift in terms of hiring. So we're looking for an increase of just 115,000 next week. And, as we've seen, the pattern of downward revisions have reemerged. So even if you get a number like that, I think you have to question a little bit the validity of that, especially when you look at things like the QCW data, which are trailing well behind what we're seeing in terms of payrolls. And if you just look at some of the more forward-looking indicators, labor demand, so job postings continue to trend lower. We've seen the NFIB Small Business Hiring Index is back to some of its lowest levels of the cycle. There just isn't a lot of appetite for firms to hire in this environment. To the extent that they're having more trouble maybe passing through some of this inflation, that's going to weigh on margins, making it that much harder for them to hire. So I think we're still looking at an environment where growth is poised to slow further from what we've already seen this year.
Sarah, really quickly here, we have just about a minute left. When you think about where oil prices have gone, yes, we have retraced some of the gains that we've seen in the heat of the geopolitical tensions in the Middle East. However, we have drifted higher relative to the past month. So we're not in July in the same place we were in June, or entering July, rather. So what does that mean for the ability for consumers to spend? Does it really make a difference?
Yeah, so we've seen consumers get a little bit of reprieve in terms of the oil and gas price outlook, I think, here over the past week or so. But, I mean, where oil prices are and gasoline prices, it hasn't been a major impediment to the consumer. I think if we can stay at these levels, I think that helps open up a little bit of space where consumers can, we're still seeing, I think, positive real income gains. It's just not quite as strong as what we were looking at 6 months ago, a year ago, as you've seen the job market continue to cool off and no longer seeing that disinflation in terms of the overall price picture.
All right, Sarah, always appreciate it. Sarah House, senior economist over at Wells Fargo. A closer look at the economic data that we got earlier this morning and a push ahead to some big economic data report next Thursday. When we come back here on the program, we're going to talk about one of the bright spots out there in the markets, and that is financial stocks. Jason Goldberg, managing director over at Barclays. We're going to talk about the banking sector. We're going to talk about the Fed, and we're going to talk about some of those capital requirements. That's coming up next here on The Close on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we start off today with Uber. Canaccord downgrading to hold amid the potential for rapid disruption in the ride-hailing space as the era of autonomous vehicles arrive. The biggest near-term concern is multiple compression. The biggest long-term concern is obsolescence. The share is down 2%. Next up, Boeing, Redburn upgrading to buy, raising the price target, with the firm saying it's confident in the plane maker's recovery. You see the shares there on your screen, rallying hard on the day, up almost 5%. And finally, let's take a look at JP Morgan. A downgrade over at Baird for the biggest U.S. bank out there to underperform, one of only 2 sell equivalent ratings on Wall Street. Now, Baird does acknowledge it's a contrarian call, but says expectations around JP Morgan's growth are just too high right now. Baird also cut Bank of America to neutral. You see shares of JP Morgan, which hit a record high yesterday, down 1% today, and those are some of our top calls. We do want to focus in on the financial sector, on that pair of downgrades in the financial sector, as the Fed is set to release its latest stress test results in just about an hour's time. Jason Goldberg joins us right now, senior U.S. large cap bank equity analyst over at Barclays. All right, Jason, let's get right to it. What are you expecting to hear? And more importantly, are you expecting to see any real fundamental changes to the way the Fed makes these calculations?
Yeah, so after the close tonight, we'll get the results of the stress test. And I think the number one takeaway is, at least for the U.S.-based institutions, they're all going to pass, which means they have enough capital to get through a severe economic downturn. One of the things that we do from the stress test results is calculate what the bank's new capital requirements will be for the coming 4 quarters. And we think one of the things you'll see at the biggest banks is a reduction in their capital requirements, over the next 4 quarters, in part because of the capital they built over the last few years, and in part because you have an easier test than last year. Now, it's still a very hard test, don't get me wrong, but a less strenuous, severe case. And we think the group as a whole will fare relatively better. Looking out, I think that will allow the banks to maybe lend a bit more. We should see some dividend increases, we think, next week, and a little bit more in share buyback.
Who do you think, Jason, is best poised to really increase that capital return story, and how much will it matter to the stock?
Yeah, no, we think, listen, I think dividends and buyback is certainly part of the bank kind of total return story. When we look at our coverage, from a dividend standpoint, we think you can see above average increases from names like M&T, Wells Fargo, JP Morgan. From a share repurchase perspective, Citigroup, given where its valuation is, could be a standout on that front.
Jason, when we talk about the idea of the health of particularly with the large cap banks, there is this general idea that most of them are in great shape right now, and some of them certainly improving, like a Wells Fargo, some of them already at the pinnacle, like a JP Morgan. But there are a lot of questions about valuations when you consider how far some of these names have run. And the question as to whether, when we start to see these earnings reports out of these companies starting mid next month, whether that's going to justify that run up.
Yeah, no, certainly the group has, outperformed year to date, has had a decent move off kind of the tariff lows. But if you look where valuations are, we're still below historical averages. So like on a forward PE basis, the group's at 11.5 times. Historical average is probably closer to 12.5. On relative to the market, the group's up 55%. Historical average is closer to 70. So in kind of think about a backdrop looking ahead, to the extent that you have an unemployment rate in the low fours, GDP growth, we think, which could accelerate over the next couple of years once we kind of get through some tariff and tax and immigration reform, and an interest rate backdrop, which is kind of normalizing. The Fed should have a measured cut over the next couple of years, steepening yield curve. So we think this group is poised to put up, some pretty good earnings growth, over the next few years, which should allow, we think, valuations to expand. On top of that, after the last 15 years, essentially, you've seen the regulatory environment get kind of more stringent every single year. And this is the first year you're kind of seeing, we think, some, normalization or some pragmatism kind of returning to it, which we think should also aid valuations.
Jason, really quickly here, too, if you had to kind of boil down when the rules lightening will really start to matter when it comes to what the banks are able to do, when does that deregulation story start to take effect?
I think it already is. Like, if you think about it, earlier this year, they got vacated a potential, cap on credit card late fees or service charges. Earlier this week, the Fed, along with the FDIC and the OCC, issued a proposal to kind of lower the leverage ratio minimums. The Fed has promised to make kind of next year's stress test more transparent and reduce the volatility we think is beneficial. Earlier this year, you had the FDIC and the OCC kind of take back some of the M&A language they put out last year to make it more stringent. So I think you're starting to see it, but there's certainly more to come over the next few years. But you have a Fed with Mickey Bowman as a new Fed vice chair of supervision. Right. We think committed to making it a bit more
Jason,
easier
we got to leave
for the
it
banks to
there.
lend.
We're coming up against a hard break. That is Jason Goldberg, large cap bank equity analyst at Barclays. Coming up, more markets and President Trump's trade deals.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Shonali Bassick.
It's kind of interesting, Shonali. We did open on the S&P today above that record high. We held it for a good portion, but we did see it sort of fall back below that 61.44 level. And a lot of that seemed to be tied to some headlines surrounding trade and trade deals that maybe are off the table between the U.S. and Canada?
It's kind of amazing. You had the president, his administration, move forward with progress on China, with the EU, where there was a lot of tension, yet Canada's the big holdout.
And that was kind of surprising, right? Because you had Lutnick come on the air yesterday. He basically said a lot of progress on China. We heard from Scott Bessent on another network earlier today saying there was progress with the EU. But then Trump drops his Truth Social saying the big disagreement over some kind of digital services tax with Canada. And, well, tariffs are back on for them.
Yeah, we are going to talk much more about Canada in particular right now. And we are going to bring in now Kay Bailey Hutchinson, who is former U.S. ambassador to NATO and former U.S. senator for Texas, to talk all about what's happening with foreign relations as well as what is happening with the tariff strategy from the administration. Canada, when you think about how the process is playing out, they have required their first payment for the digital tax, still due on Monday, despite the Treasury Secretary looking to really pull back that what was known as the revenge tax, Section 899 in the tax bill. How do you see this playing out? What will bring the two countries closer together?
I do think that our long history of great relations with our ally to the north, Canada, will make this work in the end. There's a lot of rhetoric. There's a lot of back and forth. We know that. There's tension because of some of the early things that were said when the president first announced that tariffs were going to be part of his agenda. But I believe that both sides will see the importance of our alliance. We share that northern border with Canada, and we need to make it work, and I believe it will.
Where do you think that the U.S. is most likely to bend? Canada did leave the door open for negotiation. How quickly does that negotiation happen with the tax due on Monday?
Well, I think the way you measure what can be negotiated is what are their biggest imports into the U.S. and what are our biggest exports out, and vice versa. And I think that certainly forest products, the electricity that we provide to Canada, there are so many areas that are really vital that where we depend on each other, and there is a lot of codependency. So I think they will be working overtime to try to make sure that if there needs to be a bit of a delay in the terms, that will happen. I just have total faith that we are going to get along with our neighbor, that we will make accommodations. And I think the administration has done that like with the EU, giving a little more time to work things out. Because these trade issues, so much of it is non-trade barriers. It's not the tariffs. It's the EU treatment of American products or American companies, especially our high-tech companies. With Canada, it's energy is one of the things that both of us use up from each other. So I do believe that when you get into all those specifics, that maybe there would be a little bit of a delay in time.
Yeah, and it's hard to kind of imagine a complete deterioration in the relationship between the U.S. and Canada, and for that matter, even Europe, given how far back those relationships go, Ambassador. I am curious about your thoughts, though, on what our relationship, the U.S. relationship, is with China, or more importantly, let me rephrase that, what can our relationship with China be in your eyes?
Well, I think it is so important because we do have a lot of investment. Our companies invested in China, doing business with China. But there is a trust issue. There's no question about that. China has already apparently not kept its word on the rare earth minerals that are required for the magnets. And I think it's not the same tone as with Canada or our European allies. It's much different because there isn't that trust base. So I think the president is trying not to use high tension rhetoric with China, but on the other hand, the inequities in our trade relationship with China are huge and need to be mitigated.
Ambassador, I want to get your thoughts on something outside of the world of trade, and that is on the recently wrapped up NATO summit. And I want to just read something to you just very quickly. This was something that you said back in 2020 in an interview. You said, "I think there's no secret that President Trump had initially been skeptical about NATO, but I think that he has now acknowledged that our European partners with Canada have stepped up and are moving in the right direction." That was in 2020, back when there was a lot of speculation about what the U.S.'s commitment to NATO would be and whether our partners in NATO would rise up to meet some of the demands of the president. After this meeting that just wrapped up, where we did see a 5% commitment by all but one of the members, what you said in 2020, do you feel that that's still true?
Romaine, I think it's even more true. I think that the credit that he deserved in 2020 when we doubled the amount that Europeans were putting into their own defense at that time. But now I think Europe has come in much more believing in the importance of this. I think the summit went very well just this week. And I think now that the president is committed to NATO. He believes it is a value added for America to be the leader of NATO. It is essential, frankly, that America lead here. And I think from what's just happened with our ability to do the Israeli-Iranian issue, I think the Europeans appreciate what we did, and I think they know that only America being the lead in security for the West is the right way to go. And I think now the president understands the role of America is so important, and that the Europeans are understanding his way of operating and agreeing that they do need to do more in their home area to protect their people and to provide our umbrella with theirs for our mutual security.
All right, really appreciate you taking time for us, Kay, as always. That's Ambassador Kay Bailey Hutchison, former U.S. Ambassador to NATO, and of course, the former U.S. Senator from the state of Texas. All right, we continue to count you down to the closing bells and taking a look at some of the big names moving the market on the day. A big lift to the S&P from NVIDIA and Amazon, but also a big lift from Nike. That stock having one of its best days in years. We'll explain why on our Stock of the Hour when we come back. This is Bloomberg. All right, time now for our Stock of the Hour. Shares of Nike at one point up 19% on the day, the biggest intraday gain for that stock going back to 1999. This is on the heels of their earnings. The numbers themselves, they were okay, but it was an earnings call with the new CEO, Elliott Hill, that gave everyone a big dose of optimism. Poonam Goyal covers this stock for us over at Bloomberg Intelligence, and she joins us right now to talk a little bit more about it. Let's start off not with the quarter that was, but really what Elliott Hill had to say on that call that gave people enough confidence that maybe the worst is behind this company.
Yeah, sure. I think the first sign of optimism here was that wholesale order book for holidays was up. We haven't heard that in a long while, and that's encouraging to see and does reflect that maybe the bottom is behind us.
So is it, though? You have Nike still down almost 5% on the year. It suggests that there could be some more room to run. To the extent that investors needed more from him today, what would it have been?
More would have been lower inventory levels, but I do think that, they are working down their inventory. They have 6 more months to go. So the first half of their next fiscal year is when you're going to see still a lot more clearance. And then hopefully new inventory just fills the pipeline. And that's the way forward from there, full price sales.
Full price sales. There's also this question, though, Poonam, I think, of kind of being in the zeitgeist, of being relevant to, I guess, the tastemakers, if you will. It's something that it appears in recent quarters, Nike has kind of fallen a little bit by the wayside. Does that matter as much? Do they sort of need kind of that fashion boost, that zeitgeist boost to sort of get them back to sales growth levels that investors prefer?
It would be nice if they can do both fashion and performance, but I think the most important thing here is that they focus on performance, and that is what they're doing. When you think of Nike, you think of sports, and they need to lead in sports first, and sports shoes do become fashion shoes, right? We've seen that, so hopefully that just keeps happening.
When you think about the worst potentially being over, my question still remains, if you are entering the sports arena or staying competitive in it, rather, isn't that an expensive endeavor, especially when you need celebrities these days to make your brand more worthwhile to many?
Yeah, but who has the celebrities? Nike still endorses some of the best players in the world and the best teams. So they have the deep pockets, they can afford it, and if they bet on the right rookies, it takes them even further.
I do have to ask you, Poonam, of course, about what's happening with China, the Chinese market. Obviously, the numbers in the most recent quarter weren't great. How important is that market to Nike, and what chances do you see, if at all, that they could maybe reclaim some of their market share?
Sure. So China's 15% of their sales. Sales were down 20% in the last fiscal quarter. clearly not doing well in China. Do they need China to succeed? In the long term, yes, because China is where the growth is. So we do want to see China recover. But I think it'll take time. We're still not there. We don't see signs of a recovery. But as they go more local and, get more endorsers in China for China, build within the community, there's a chance, but it's not anytime soon. It'll take time.
Poonam, we thank you so much. That is Poonam Goyal. She is senior U.S. retailing analyst at Bloomberg Intelligence. And of course, what has been a very highly watched story. People have been watching to see the king of the castle really become the underdog.
Yeah, I mean, we talk about all these new sort of upstarts, I guess newish, the Hokas on clouds. Is that what they're called?
Yeah.
On
They
clouds.
become really
Does it feel like a cloud? Have you ever had these shoes?
They kind of do.
Yeah. Okay, all right.
That's a nod. It's all I wear.
But it's like, I mean, I primarily wear shoes for the utility, sneakers for the utility, not so much for the fashion. And I mean, Nike kind of moved away from that. Like they didn't really sort of promote the idea of the athletic performance in the way that maybe some of those other brands like Hoka did, which I think maybe is why they fell a little bit behind.
Yeah, and Elliot Hill, I think what investors are liking is that he makes no bones about it, that things are still tough out there, but he is looking to turn it around, and I think people like the honesty.
Yeah.
Coming up, we're going to take you to the closing bell because it has been an interesting trade in the market. We're going to bring in Amanda Agati. She is the Chief Investment Officer for PNC's Asset Management Group. Stick with us. Will we hit another record? Will we stay there? This is Bloomberg, The Close.
In our momentum work, and I think this shocks a lot of people, it really isn't tech driving things. Tech is part of the beta trade, and tech is certainly, from a beta perspective, driven things. But where we are today is really financials are a big part of that driver. And, financials underlying the strength of the market tend to be a good thing, not a bad thing.
Jeff DeGraff there, chairman and head of technical research over at Renaissance Macro Research, kicking us off to the close just about 50 minutes ago. And Shonali, he was kind of talking about the complexion of this huge round trip that we've had in this market from those February highs to those April lows, and now back, at least right now, 6160 on a S&P 500, record high.
It's incredible. We have seen us dip right below that record high a little bit earlier in this hour. We are back up there, 0.3% higher. The NASDAQ 100 also flipped entirely. It was down more than 0.2%, now up 0.25%. The Philadelphia Semiconductor Index, I do think this is interesting. You have had some weakness there relatively, and I watch it as a barometer to that tech trade, really. In the 2-year yield, looking at 374. It's nice and calm.
Yeah, and you're speaking of that tech trade. Of course, that tech trade really being driven by the AI story, and we just had some headlines a little while ago from the Financial Times about Meta. And about $29 billion are seeking a raise from private capital firms to fund their AI dreams.
I think this is incredible, this story. We did report a little earlier in the year that there were talks with Apollo, but now FT is reporting that many others, Apollo, KKR, Brookfield, Carlyle, PIMCO, all involved. Wall Street still wants the AI action, Romain.
Yeah, and it's good that you bring that up here, because as we move closer to the closing bells with just about 8 minutes to go, a lot of people looking at this rally and they're saying what takes it to the next level, and maybe it is that AI trade, or maybe we're in for a correction if we are still concerned about tariffs in the economy. Amanda Agati joins us right now. She's the CIO for PNC's Asset Management Group. And Amanda, this is the parlor game right now, sitting at record highs. The big question is, do we continue to go higher, or do maybe we course correct because of some of the risk out there surrounding the economy, surrounding tariffs, surrounding geopolitics?
That's absolutely right. It's great to be with both of you this afternoon. I think it is a tale of potentially two paths. I mean, the first one, the obvious one, is a little bit of what we saw late in the day here today with some social media tweets throwing the market a bit of a curveball around tariffs coming back into focus. That purple haze of fiscal policy uncertainty that I've been talking about all year is coming back to the forefront, and it's going to be a really busy summer. So I do think that has the potential to move markets. The other driver, though, is earnings season. We're just a couple of weeks away from earnings season kicking off. And even though revisions have been kind of negative coming into earnings season, we still think the fundamental backdrop is pretty sound. So I think it's a little bit of a tale of two halves right now.
Do you think earnings, though, are going to hold up as we get into the next season, which will be those second quarter numbers, but more importantly into the third quarter and the fourth? I mean, we've started to see some revisions to the downside, which I was kind of surprised about.
Oh, yeah, we definitely saw some pretty steep negative revisions. It wasn't quite as bad as what we saw going into Q1, but it certainly was pretty negative. That slowed down about 3.5 weeks ago. So we think the bar is set appropriately low enough for results to come in. And clearly with the delays around tariff implementation, I think the results are going to actually come in better than expected. Maybe we've set the bar a little bit too low. But I do think the fundamentals and the balance of the year still look strong. If you zoom out, we're still looking for 9 to 10% earnings growth on the S&P 500 year over year. That's good enough for a market, even trading at these valuation levels.
Amanda, Romaine and I have been talking throughout the hour about the lack of breadth in this market, this whole idea that only over 5% of the S&P 500 companies are really trading below their 50 or trading at their 52-week high. You're not getting a whole lot of breadth either for companies trading above their 200-week moving average. What does this all mean at the end of the day for you when you think about the areas of the market that are left behind?
Yeah, it's a great point. We've actually been in a fairly narrow breadth market for quite some time, and extends well into the rearview mirror. It's not just a function of this year. Would I like to see more market breadth? Absolutely. A broader market participation environment certainly is a healthier catalyst to keep this market rally going. But the nature of the index, the composition of the index, the weightings in the index just continue to drive this narrow subset of leaders that are continuing to lead the charge with fundamental strength. So I still think the leaders are still the drivers. They're still in the driver's seat. But I think Q2 is going to be pretty telling in terms of whether we start to see some broadening in terms of the fundamentals. We actually saw a pretty broad fundamental participation coming out of Q1. Didn't really translate into price returns across the market. Q2 could see a little bit of a different backdrop.
Correcting myself, 200-day moving average. Amanda, it's been a long week. Very sorry. 200 weeks is a very long time. Now, you look at the components of today, and actually some of the broadening is quite interesting. We were talking a little bit earlier about Nike as well. Of course, it's flying, but it's really not the only one in the consumer discretionary index flying. Most of that index is higher. How do you feel about the consumer trade right now and its ability to power the rest of the index?
Well, you know, it's a great question because up until very recently, consumer sentiment was really in the dumpster, right? There was a big distinction between hard data coming in still very sound, if not better than expected, and softer data, survey data being really, really severely under pressure. U of Michigan bounced into really positive territory with its most recent reading. So I think that's a reflection of the consumer saying, well, maybe this whole tariff and trade-related policy thing isn't going to go off the rails, right? There's a big pull forward in terms of both spending activity and concern about what it means for the path forward. We're not standing at the edge of a recessionary cliff. You know, jobs market's still hanging in there. And so I think what you're seeing in survey data is a consumer that's still cautious, but feeling maybe a little bit better about the backdrop. And so I think the consumer continues to hang in there.
Real quick here, Amanda, when we start to talk about the potential support by the Fed in a market now that seems to be relatively convinced that we're going to get 2 rate cuts this year, maybe another 3 or even 4 as we get through 2026, what are you modeling in right now?
We're only baking in 1 rate cut. If you look at the way the data is coming in, it actually doesn't suggest much policy action in either direction. It's not leaning in favor of cuts or hikes at this point. Thankfully, no hikes. And so with the Fed very focused on it, more of a dovish kind of stance, you know, their bias is toward cutting. That's a very powerful lever, even if they're not taking any action. And so we're only baking in 1 rate cut much later in the year. Of course, the market wants what the market wants, craving the sugar high for more policy accommodation. But I think it still is very supportive of the market at current levels, and financial conditions continue to ease, also supportive of the backdrop.
Amanda, have a wonderful weekend. Amanda Agati there, one of the best in the business, CIO for PNC's Asset Management Group, counting us down to the closing bells with just about 2 minutes before we get there. Some interesting price action in the market right now, Shonali, with the S&P getting back towards those session highs, which would be a record high. And that seems to be on some big gains that we're seeing here in the final few minutes of trading in names like Alphabet, Meta, and some of the other big tech names.
This is a market that needed that sigh of relief. Honestly, we're heading into a shortened week next week. You have people that probably want to go away and can take a vacation. Relatively low headline risk. The VIX is at 16, and some trade deals cut.
All right, we're going to break down all of today's market action and push ahead to that holiday shortened week next week. Shonali Basak alongside myself, Romaine Bostic. I guess I should have said it the other way, right? That would have made more sense. But joining us right now here to help break down all of today's market action, we want to bring into this conversation Emily Grafeo, Bloomberg's markets reporter here in New York, and Jonathan Levin, a columnist for Bloomberg Opinion, who joins us from beautiful Miami. And Jonathan, I'll start with you since you are the man down there in the heart of it all, as Shonali would say, the real Wall Street, the new Wall Street. Talk about this record high and really the run that has gone, in just 80 days from what was gloom and doom, we were all headed towards a bear market, to now back to a record high.
It's totally wild. And I think right here, we really need to be cognizant of the upside risks, because what always happens at these all-time highs is it feels like, oh my gosh, we're here, valuations are so strong. But look at what happened in August 2020 in that breakout, which felt so perilous at the time. Look also at what happened in January 2024, when people were still talking about recession risks from those cuts. So I think we need to put our thinking caps on here, and we need to think, what could still go right here? Could those rate cuts actually deliver for us?
What do you think about that, Emily?
I mean, yeah, I think that's definitely something that's on the mind of investors right now. A conversation that I have been having a lot this week and last week as well was just that investors have been so conditioned to buy the dip over the last several years and maybe even the last several decades, honestly, in this era of low rates. Now that rates are higher, if we don't get that rate cut from the Fed, will this rally be able to continue? Well,
you see the cheering and the clapping, and certainly appropriate to do so. We should point out, it looks like the FTSE Russell ringing the bell on the NASDAQ. A big reconstitution of the FTSE Russell index is coming after the bell tonight. Meanwhile, you see the numbers on your screen. A Dow Jones Industrial Average up more than 400 points or a percent on the day. A NASDAQ Composite up a half a percentage point on the day. But the real star of the show is the S&P 500, 6172.97 to be precise, up 32 points or 0.5%, the first record high for that index since February 19th. The Russell 2000 also getting in on the action, though only fractionally on the day, up less than 0.1%. We should point out all of the indices, Shonali, higher on a weekly basis.
What an exciting week it ended up to be. You look at the S&P 500 and you have the components of it. It actually was led today, actually not by just tech. It was led by consumer discretionary. And that was the likes of Nike driving it higher. Tesla was actually down on the day, and the consumer discretionary sector still much higher. Communication services, industrial, staples, real estate, financials, all higher. Really, the only two things lower was healthcare and energy. Emily.
Let's look at the gainers. And you're right, Shonali, it's not just tech driving this market higher right now. Nike shares rose as much as 18%. It was actually the biggest intraday jump since 1999, when it jumped 22%. But really here, it's upbeat earnings. They're rekindling enthusiasm about the company's turnaround efforts after their CEO, their longtime CEO, Elliott Hill, came out of retirement and started to lead the company again in 2024. The company today forecasted a smaller than expected drop in revenue for the current quarter, and analysts here are noting that they're refocusing on sports and a cleanup of inventories, and that's boosting the stock. Another name up today was Core Scientific. This was a Bitcoin miner. It was up about 2% today, but it's continuing a rally after it jumped 33% yesterday following a Wall Street Journal report that CoreWeave, which is a cloud infrastructure and AI firm, is in discussions to acquire Core Scientific. And this is not the first time we've heard deal news for these two companies. CoreWeave had actually made an advance earlier last year when it offered to buy Core Scientific for about $1 billion. And now that market value of that company is about $4 billion. And then finally, Boeing was also in the green today, getting some positive news after a string of recent crises here. They got an upgrade at Redburn. The analysts there saying that the company seems to be speeding up production of commercial aircraft, and they're taking steps here to move on from, of course, all of that negative, those negative headlines. They boosted their price target to $275 from $180. And again, those analysts over at Redburn saying after years of troubles, things seem to be taking a more positive turn, and the company appears healthier.
Jonathan?
Yeah, so for the losers, I want to call out Palantir here, the data analytics firm, dropping 9.4%. And a lot of that coming towards the latter part of the session, Romaine. I got to think a lot of this is really profit taking after yesterday's all-time high and an absolutely insane run. They were up around 270% since September, so you can't blame folks for taking a little off the table, a few chips off the table, as it were. It trades at about 209, 210 times blended forward earnings. So this is really the ultimate story stock, and it only takes a little wrinkle in the story to say, let me take some of those chips back.
Yeah.
I also want to call out J.P. Morgan. It was down more earlier. I only have it down 0.6 here at the close. Also down from a high. We had Barrett analysts led by David George saying that they, quote, simply think that expectations are super high here. So that's another one that maybe just got a little bit ahead of itself. Of course, everybody's all bulled up on the banks. You were talking about this earlier in the show. People are excited about what's going on with the supplementary leverage ratio, but is it priced in here? That's the big question. And finally, I wanted to call out Uber. Falling 1.7% today. Again, another stock here that hit all-time highs, and we have some research out from Concord calling out concerns about potential rapid disruption. What are they talking about? Obviously, it's the robo-taxi story and what role Uber is going to play in that going forward.
All right, let's get a quick check on yields here. On the day, you see the moves there, but it's really the weekly moves that are much more important here. The 2-year yield down about 17 points on a weekly basis. The 10-year yield down about 10 basis points. And the 30-year yield only down about 5 or 6 basis points. And this is significant because it does reflect the steepening of the yield curve, a big bet by this market that they do anticipate some sort of meaningful move in the Fed funds rate sometime this year. All right, guys, one reason I was so excited, not only to have Shonali here, but also Jonathan, because both of you are at polar opposites of this big debate of where Wall Street. Shonali tells me that Wall Street is not a place; it's just an ethos, it's an idea. And there's been a lot of talk, Jonathan, about the mayoral primary here in New York. Of course, Zohran Mamdani, a Democratic socialist, that's the party he belongs to, appears to be the front runner right now. Though, of course, the final tally has not been concluded. Andrew Cuomo plans to stay in the race, but there's a lot of concern that if Mamdani actually does become the mayor in January, we could actually see an exodus of folks from Wall Street down to Florida.
Yeah, let me take this one. Okay, so the bull case on Florida has always been basically three things: sun and sand, a deal on taxes, and the fact that we're really close and accessible to New York, right? So if you're going to tell me that I'm laying out a bear case for New York and New York finance, but that's somehow going to be great for Palm Beach, I'm pretty skeptical. I've always thought, yes, there's something to the Wall Street South story, but we're never going to replace New York. Like that's obviously just plain ridiculous. And so I see it more as when New York does well, South Florida does well.
Now, my question is, Jonathan, too, it's that when you think about Florida and the move down to Wall Street South, and I've got to admit, I was kind of joking with Romaine. The minute we saw the news, I got a lot of text messages from people who were in and around our bullish episode that covered that move, around how everyone wants to move now. I was like, okay, probably not right away. But you also have a lot of contenders, right? Romaine mentioned Andrew Cuomo. There's a shot at Eric Adams' comeback into the election as well. How much are they speaking to what New York voters were looking at, which is really, in large part, an economic problem, a housing problem in the city?
Yeah. Emily, you're not moving, are you?
I'm not going anywhere.
Yeah. Okay. All right. So you're wedded to the real Wall Street here.
It's a culture.
Yeah.
If you're a New Yorker, you stay in New York.
Bloomberg TV headquarters are in New York, so we all kind of have to stay here, don't we?
But it does get to this idea, though, too. I mean, I know you interview a lot of folks, Emily. I mean, I felt like when I started my career, anyone you interviewed in this space was probably based here in New York and, maybe Chicago or Boston, but that was about it. And now they're all over the place. It's Charlotte, it's Dallas, it's the West Coast, it's everywhere.
Yeah, I mean, I read about ETFs a lot, and there's actually a very large pocket of ETF people in Wheaton, Illinois. So you don't have to have, financial innovation. It's not confined to New York City. You can get it when you go further inland into the United States.
Yeah. By the way, I'd just like to point out that's a suburb of Chicago, the
Yes,
greatest,
but it's like
the greatest city
outside.
in the world. I'm going to claim it anyway. All right, our thanks there to Emily Grafale. Our thanks to Jonathan Levin. Appreciate both of you jumping in here to help us break down all of today's market action. And we're going to say goodbye to Shonali Basak, of course, the co-host of Open Interest, the host of Bullish on Bloomberg Originals as well. Meanwhile, we continue our coverage here on The Close. When we come back, a conversation with Sarah Bianchi, Chief Strategist of International Political Affairs at Evercore ISI. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All right, well, all the will it or won't it, that whole debate is being put to a rest today with the S&P 500 finally reclaiming its record high. A record high first set back on February 19th. It's been 80 days since, and 61.73, it finally did log that, up about 0.5% on the day. We should point out all of the major indices here in the U.S. posting pretty healthy gains on a weekly basis, and that includes financials. The KBW Bank Index, it may not look like much, only up about 0.1%, but it did have a phenomenal week, and the S&P financials hitting a record high as well. Spot gold doing something it hasn't done all year long, and that's actually fall for 2 straight weeks in a row. And you see a little bit of a clawback in WTI crude on the day and on the week after 3 straight weeks of monster gains. As far as some of the individual movers to pay attention to, Nike having one of its best days in years on a relatively encouraging conference call with the new CEO, Elliott Gill. Estee Lauder moving higher on an upgrade, Uber moving lower on a downgrade, and keep an eye on Circle, pulling back just a little bit, down about 15%, but that's, of course, after the stock doubled from its IPO price. And there's been a lot of talk right now here about what comes next for this market, and that really does bring us to our top story of the day. And it's a big number, 80 days. That was the number of calendar days that it took the S&P to reclaim that February 19th high. That is the fastest recovery from a major S&P drawdown since an 83-day round trip back in 1982 amid the Paul Volcker-induced bear market. It's a stunning about-face, and it was largely driven by sentiment rather than fundamentals. And that has left a lot of folks out there asking what comes next. Tariff headwinds have abated to some degree, but there's still concern, and we're going to talk about that in just a bit. Wall Street analysts still see corporate profit growth subdued this year. A lot of companies still grappling with the threat of those tariff swings. So maybe that's why, despite today's record high, 50% of the index's point move since that April low is attributable to just 10 stocks. Maybe that's why more than half the stocks in the index are still in the red since the February peak. And maybe that's why that the percentage of S&P members trading above their 200-day moving average has actually slipped since mid-May. So what does come next? What can market cycles of the past tell us about the market cycles ahead? Well, Chris Kane is quantitative equity strategist at Bloomberg Intelligence, and he's done the heavy lifting for us, and he joins us now for our Factor Friday. Chris, great to have you here.
Absolutely.
Let's talk about what history might tell us about the future.
Yeah, to not bury the lead, it's a good time to buy at all-time highs. It's a little bit counterintuitive, but it's true. We looked at every time the S&P made an all-time high after at least a 20% drawdown, so a classic bear market. The main conclusion of that research is that the volatility is significantly lower in the forward year after the all-time high. So when you use all the data, the annualized volatility of the S&P 500 is about 15%. That next year, it's about 11 to 12%. So it's a significantly lower vol. It's kind of funny to say it's less risky to buy after an all-time high, but quantitatively, that is true.
Okay, so that looks good. I mean, you see a drop in volatility. I would think that's good. But does that translate necessarily into higher returns?
It does. It does. When you look at the median forward year returns, it's about 15%. So this is 11 instances since 1950. Again, a new all-time high after a bear market. The average return for the S&P is about 12%, so it is higher returns. You did kind of steal my thunder, Romaine, because I was going to say about the this is the quickest recovery after a drawdown to a new all-time high.
You know where I learned that, Chris Kane? From Bloomberg Intelligence.
Well, smart people over there.
From Gino Smart and Adams, yeah.
Yeah, so the performance is very strong, lower volatility, higher returns over the next 12 months after the all-time highs.
All right, so talk about what the distribution means and kind of put that also into historical context.
Sure. When you look at just averages or medians, it could hide the distribution of returns. So basically, they're very strong. Of the 11 instances that we looked at, 10 of the 11 times the market was higher in the next year. The only time that wasn't true was the 2007 experience, but even that was just down about 6% over the next year. You compare that to the best return, which was 36% after the 2020 all-time high. So the distribution is heavily skewed positive with only one negative result.
Wait, so go back to that. So in 2007, you're talking the worst 12-month return was just 6%?
That's right, after the all-time high.
Okay, and what about like on a 6-month basis?
So 6 months, the worst was only 3% down.
Okay.
So it's the worst case scenarios, at least historically, have really not been very bad.
All right, Chris, always a great look at what actually is moving the market. Chris Kane here for our Fractor Friday, analyst over at Bloomberg Intelligence. All right, when we come back, we are going to talk a little bit more about trade. A lot of headlines right now coming out of the White House on a potential call off of that Canada trade deal. We're going to unpack the latest and what's going on with Sarah Bianchi over at Evercore ISI. This is The Close on Bloomberg. All right, time now for our top three, where we name drop the people driving some of the day's most talked about stories. And we start off with Roger Federer. The tennis superstar is now officially a tennis billionaire. While the bulk of, we should point out, he won about $130 million in prize money over his career, but the bulk of his wealth is actually coming from sponsorship deals and investments, including a 3% stake in the sneaker company On Holding. Next up, James Ryan. He's the University of Virginia president, or he was. He's stepping down, according to people familiar with the matter. The move comes as the Trump administration continues to probe the school's DEI efforts. And rounding out our top three today is Scott Bessent, the U.S. Treasury Secretary, signaling there are more extensions or some extensions to wrap up major trade deals by the Labor Day holiday. Of course, there have been a lot of headlines this afternoon about what the status of those trade talks are, with the biggest hiccup apparently occurring between the U.S. and Canada. The President of the United States just a little while ago posting on Truth Social that he is ending talks with Canada over concerns about digital services taxes. Canadian President Mark Carney weighing in, saying that the complex negotiations will continue, though he said he has not yet spoken to President Trump. Meanwhile, Howard Lutnick said the U.S. is inching closer to a major trade agreement with China, and Bessent himself said the talks with the EU are actually going, and maybe they can actually get things done by that July 9th deadline. So here to cut through it all and hopefully bring some clarity as to where we go next is Sarah Bianchi, Chief Strategist of International Political Affairs and Public Policy at Evercore ISI. That was a mouthful, Sarah. I want to start off with Canada, because I think that kind of shocked everybody. A little bit earlier, Trump came out on Truth Social raising the issue about this digital services tax and basically saying that, look, we're walking away from the negotiating table. I don't know how much of this is bluster, how much of this is real, but I am curious as to where you see the U.S.-Canadian trade relationship going.
Well, I think it's an important symbol and telltale sign on all of this, which is that these trade negotiations are really tough. These are sticky issues for a reason. And so even though Bessent wants to get all of this done by Labor Day, things come up. Canadians today on the digital tax not moving fast enough for much of what Trump wants. Some of those taxes actually come due on Monday, so it's a real issue. I think what it reminds us is I do think that they will get back to the negotiating table, the Canadians and the United States, but there's a lot of sticky issues, and this is going to be a bumpy ride. I think a lot of investors are hoping that July 9th is just a kumbaya, this is done and over. But we like to remind investors there's a lot of sectoral tariffs left to come on pharmaceuticals and semiconductors, and there's hiccups along the way with these trade deals.
I am curious as to what deals do you anticipate could potentially get done first? Not necessarily by July 9th, but when you look at sort of the queue of companies lined up, which ones have the most promise of getting done relatively quickly?
I think the United States-India deal is top of the list, which is ironic for many trade negotiators because those are often very, very difficult negotiations. But I think President Trump and Modi have had a good relationship. And also, India has a lot of high tariffs, so they can actually have more to give than countries where we may have an FTA, a free trade agreement with. Vietnam is apparently moving quickly. I do believe if that does happen, the tariff rate will not end up down at 10% like we saw with the UK. I think it'll be closer to 20 or 25 because there's a lot of concerns in that relationship. People like to say that Japan and Korea are coming quickly. I'm a little bit more skeptical there because they have a lot of sectoral tariffs, meaning tariffs on autos and steel, which make up the bulk of their exports to the United States. And until that settles out, going to be very hard for them to cut a deal.
There's also this issue of kind of export controls and other sort of, I guess, non-tariff trade issues that the Trump administration has made a big deal about. Are we any closer to maybe potentially resolving some of those issues, or is that on the back burner?
I think that this administration is very, very far from having a theory of the case of where they want to go with critical export controls, particularly around chips and semiconductors. They have put out a few export controls in other areas. That's some of what caused a bit of a breakdown with China. But in terms of where they want to go on that core issue, right now, all they've really signaled is they want to get rid of the last Biden rule and they want to be tough. But these are some of the most complicated policy matters, very technical. I think it's going to take them a while to really land where they want to in terms of what kind of chips the United States is able to export.
Of course, also the other big elephant in the room, if you will, down in Washington is that budget bill, Sarah. Of course, there was some hope that maybe this would get done before the July 4th holiday. I know they've made some progress over the last couple of days, removing certain provisions that had been big sticking points. I know they still have to resolve the SALT tax issue, though there were some headlines earlier today that seem to suggest progress on that.
Look, I think there's still a chance they get this done. We're going to have to see whether or not the Senate really starts voting this weekend. There's nothing like a deadline that make Congress act, especially a holiday. I think they all understand the disadvantages of letting this hang out through the month of July. Yeah, there's hard calls, unpopular positions. It's not like there's some compromise nobody's thought of. So I still think it's a possibility they get it done weekend. As you mentioned, I think they're getting closer on SALT. There's still some real issues around Medicaid that need to be resolved, as well as the Inflation Reduction Act. The Medicaid cuts are very, very steep, and I think it's making a lot of moderates in the Senate and the House quite nervous.
Is the consensus, and I don't necessarily mean the politically slanted consensus, but is there consensus out there that despite some of the, I guess, more negative aspects in this bill, that overall this could actually be additive to our economy?
There's no question that when we do the math, it is stimulative in 2026. There are provisions around the child credit. There's some defense spending. So we are definitely tracking a stimulus in 2026. I think what people are concerned about is the addition to the debt. That is something right now the market has been a bit jittery about, does seem to be looking through that at this moment. But this is a big on track add to the debt, and I think there's certainly people that makes very nervous.
All right, Sarah, appreciate the analysis. Have a wonderful weekend. Sarah Bianchi is the Chief Strategist of International Political Affairs and Public Policy at Evercore ISI. As we take a quick check back on the markets had just closed ahead of a holiday shortened week. And it is a record high, finally, for the S&P 500, 6173 and change, a $10 trillion rally off of those April lows that returns it back to those levels from early February. But big questions now about what's next, particularly with the tariff issues still hanging out there, the issues in the Middle East, and of course, the big issues with the budget bill. We should point out one of the sectors that performed incredibly over the past few weeks was financials. And we are awaiting the latest Fed stress tests, which could potentially add some more fuel to that fire. Stick around. We'll have those results for you when we come back, right here on The Close on Bloomberg. The Federal Reserve here in the United States conducts annual stress tests of banks to see just how potentially solvent they are, particularly in the face of any stress. The Fed is now saying that all 22 banks in that stress test have passed, comfortably clearing the bar that they have set. Of course, this is most important for investors as the passing of this test, of course, opens up the possibility for an increase in capital returns, whether through buybacks or dividends. Joining us right now is Sally Bakewell, who helps lead our U.S. finance coverage here. And of course, the big red headline crossing the terminal is that the Fed says all 22 banks, Sally, did pass that annual stress test. What do we know?
I don't think that's a huge surprise. Most analysts were expecting them to pass these tests. And of course, these tests, the big thing is that they have a huge impact on banks because they signal whether the banks could likely plan to buy back more stock and or raise their dividends. And the results of the test determine exactly how much capital banks have to hold as a kind of buffer to external shocks, and thus determines how much they can increase payouts to shareholders. And the Fed this time, it estimated that the group of banks' common equity tier 1 capital ratio, which provides that cushion against losses, it declined, but it still is much more than double the 4.5% minimum requirement. So they're in pretty good, this annual health check shows they're in pretty good shape.
And we should point out, of course, our Bloomberg reporters are still kind of parsing through this, trying to get us some more details on this. There was an expectation that we could actually hear from the Fed about a potential revision, if you will, of the methodology that they use in here that could actually make it a little bit easier to pass these tests in the future.
That's right. Under Trump, regulators are expected to seek changes that relax some of the stress test framework, which was established after the 2008 financial crisis. And the Fed said in December that it will overhaul its stress tests of big US banks to kind of smooth out changes in required capital levels from year to year. Banks have long complained about these tests, among a lot of other capital requirement regulation that they face. They've said that the methodology is not transparent. JP Morgan CEO Jamie Dimon has been particularly vociferous, calling the stress test capricious, arbitrary, inconsistent, and volatile. So we'll need to pass through to see if they manage to actually address some of these issues or not.
All right, Sally Bakewell helps lead our finance coverage. Again, just to reiterate those headlines, the 22 banks subject to these stress tests did pass it once again here. Though we should point out the common equity tier 1 capital ratio did actually decline by 1.8 percentage points. But the Fed says that those lenders are still well above the 4.5% minimum requirement. And overall, we should point out that it has been a relatively good week for banks. You have the potential easing of a key rule on capital ratios and, of course, potentially some favorable tweaks to the Fed's stress tests going forward, all against the backdrop of a less volatile global economy. And all this is raising speculation that the door may actually be opening for banks out there to start taking on more risk and doing more deals. A number of borrowers already looking to syndicated loans to refinance existing private debt. An appetite for direct loans is improving. And that's where people like our next guest come in. Vivek Matthew is president of Antares Capital Advisors, and he joins us here in Studio 2. Great to see you here.
Hey, Romain, great to be here.
How's business been as of late?
Business has been really solid. We've been really happy with the deal flow that we've been able to generate to put money to work on behalf of us and our investors. So we actually, I think, felt like M&A for a while would have been slower than it's turned out to be. So I would describe M&A activity and therefore our deal flow as pretty solid. So perhaps not spectacular, but solid. So we've been happy with it.
I'm curious about that too, because there was a lot of gloom and doom kind of earlier in the year, and there was a real dearth of deals for some time. But then I was looking at sort of the numbers on a year-to-date basis, and we're kind of keeping pace with last year on certain metrics. I know we're still well below kind of those peak years that we had. What was it, in 2021, 2022? But are we getting back there?
You're exactly right. So let's talk a moment about where M&A has been and perhaps where it's going. So as I mentioned, I would characterize M&A so far in 2025 as solid, not spectacular. And I think that's maybe a slightly more rosy picture of it than many have described. And I think the reason is more around expectations management, because at the end of 24 going into 25, I think there were a lot of technical reasons as to why we thought M&A could be like 21. So you had private equity firms with a lot of capital that they had raised but not spent. You had investors that were looking for return of capital, and private equity firms wanting to accommodate that. And also at the end of 24, we felt like we had a handle on inflation, so it gave a nice long-term backdrop as well. So you head into 25 thinking this is going to be like 21, and we didn't get that. We didn't get that because of trade. We didn't get that because of geopolitical concerns. But it's not to say that it's been poor. So after Liberation Day, where things looked really slow, things have picked up. And I think the reason for that is twofold. One is those reasons that I mentioned about having capital to put to work and also investors wanting return of capital, those reasons haven't gone away. So we've seen a little bit more activity pick up. The second reason is that lenders like us have an existing portfolio. So we finance private equity sponsors M&A activity. We've got a portfolio of $85 billion of stuff where we're already lending. Well, when those companies become successful, when they want more financing, we're well positioned to give it to them. So when you combine those two things, we're actually ahead of an average year in terms of putting money to work for our investors. So we're happy with that.
With regards to your portfolio, I mean, what's the duration looking like, and are you comfortable with it?
Yeah. So I would term the portfolio as resilient. I think that's probably the right word, because there's been a lot of surprising things thrown at the credit markets in 2025, and private credit kind of continues to turn out consistent results, which I think is why investors have gravitated towards it. So I'll give you a couple thoughts. So revenue and EBITDA continue to increase at a nice positive pace. The industries that we tend to be overweight in are performing really, really well. They're also inflation resistant. They're also tariff resistant. So that's helpful. Our watch list.
Can I just start you there? Because I mean, you guys are pretty pretty diverse in terms of industries and stuff. Are there certain industries though that maybe you're a little bit more overweight to, or does that not sort of factor in?
Yeah. So we tend to be overweight industries that we view as being not cyclical, and they tend to be more service oriented. So our favorite industries are healthcare, our software, our services to businesses, and services to financial institutions. So those industries are not heavy commodity using industries. They're not heavy manufacturing industries. So that kind of insulates us from tariffs. They don't really get a lot of their inputs or sell their products abroad. So those industries, we tend to be overweight those. Those are performing really well. And then if you look at our watch list, that's the other, so loans that we're keeping an eye on for one reason or another. That watch list is quite stable to declining. So we're really happy with where the portfolio is performing.
Just real quick question on secondaries. I know a lot of people have really found a lifeline in secondaries. Do you think that uptrend is going to continue?
Yeah, so I think that when you talk about secondaries in private credits, which is a private market, I think you can talk about two things. What we're talking about is what we call liquidity solutions or credit secondaries, where, so let's take an instance where an investor is an investor in a long-term fund that typically doesn't have liquidity. Maybe it'd be an interesting option for them to get liquidity. Maybe we're managing a fund that has a bunch of investors, and we can bring in new investors and give the old ones liquidity. So these are actually some technologies that we're borrowing from private equity, but we're tweaking them a little bit for the credit side. And so we have had investors come to us and say, hey, I'd be interested in liquidity, not because there's problems with performance. Performance in private credit's been good, but maybe their public markets portfolio is experiencing volatility, so some sort of denominator effect, or the private markets portfolio is not getting return of capital from private equity. Whatever the reason, liquidity, I think, is something that's interesting in a private market that hasn't really existed in private credit. I think you're going to see us and other market participants do more of this and have more of that available.
That's interesting. All right, Vivek, we have to leave it there. We got to get you back on for a longer conversation. Really fascinating stuff. Vivek Matthew, president of Antares Capital Advisors. Stick with us. We'll be back in a moment. This is Bloomberg. All right, there were a flurry of U.S. Supreme Court decisions as it wraps up its latest term, so it's worth taking a look back in history at a landmark ruling that changed the face of college sports. On this day, June 27, 1984, two powerhouse football programs, the Universities of Georgia and Oklahoma, had sued the governing body for college athletics, claiming the NCAA's control over broadcast television rights and its control over how money from those rights was distributed, that amounted to unfair restraint on free markets. Now, for more than 3 decades, the NCAA had sole power to negotiate TV contracts collectively for its colleges and sole power to regulate the number of games broadcast. The result was only a couple of games could be shown each weekend on broadcast television, and TV revenue, that was often divvied up equally among schools rather than apportioned out based on which teams got better ratings. So after years of litigation that worked its way up to the highest court in the land, the justices in a 7-2 decision determined that the NCAA was violating the Sherman Antitrust Act. Within weeks, schools were free to begin negotiating their own deals. Some did it collectively. Others, like Notre Dame, struck exclusive solo agreements, while the remaining schools realigned themselves in conferences that would give them greater leverage in TV contracts and exposure. The number of regular season college football games on TV exploded, more than doubling within a year to almost 200, and it was directly responsible for the growth of a struggling sports network out there called ESPN. Media revenue for individual schools over time jumped from 7 figures a year to 9 figures. And now here we are 41 years later, and the NCAA is on the precipice of another monumental change when next week it will start paying student athletes directly for the first time ever, largely through revenue sharing. It's part of an agreement that settled a trio of modern-day antitrust lawsuits that, like in 1984, is likely to fundamentally reshape both college and professional sports for years to come. And that is where we want to take this conversation right now and talk, well, not about college or professional sports, but how about recreational sports? Volo Sports has reached an agreement to acquire Zog Sports, the second largest recreational league organizing platform. The acquisition follows a $21 million investment in Volo by Bluestone Equity Partners. And I'm pleased to say that joining me right now is the founder and managing partner of Bluestone Equity, Bobby Sharma. I should point out he's also a former executive of the NBA, leading the creation of the NBA's first minor league. Great to have you here, Bobby.
Happy Friday. Happy to be here.
When we had you on, I just want to point out that one of our producers apparently uses your platform quite a bit to get to our kickball games and other things. So we had a lot of great conversations about this. I didn't know recreational sports was that big of a business.
Increasingly so.
Yeah.
So we're in the business of investing in market-leading businesses. Volo is the market leader in that space. We're very proud to help execute on what has been all along an M&A roll-up strategy in the space with Zog Sports, the second biggest platform.
So when we talk about the types of people who use that, these are just basically everyday weekend warrior types that are using these platforms?
100%. And another added feature that Zog brings to the table for us at Volo now is corporate leagues. There's a lot of that in New York City. Both the businesses have built not just strong businesses, but strong brands and communities and cultures around them, centered around health and wellness and around social interactivity. And I think generationally and even wider as a society, we're now leaning more into experiential, in-person events. Health and sports is sort of the pinnacle of health and wellness, and a great way to meet people and get healthy at the same time.
So Bluestone's relatively new. You've made a few investments so far. I mean, a couple that we've talked about, but a couple others. I was trying to sort of wrap my head. I mean, it seems like a lot of it has somewhat of a health focus, as you just talked about, but also a bit of a media focus as well.
Yeah, Bluestone, we've had a very clear and focused investment strategy from day one, which is to say lower middle market, structure growth and buyout, asset type agnostic. We look for high growth businesses, high barrier to entry that we can contribute growth towards. We're specialized investors. As you mentioned, I spent 10 years at the NBA, 4 years at IMG building professional sports leagues. I have amazing investors on my team from firms like Apollo, Blackstone, Abry Partners. So we have a very rare combination of high levels of investment acumen and industry experience and expertise and relationships. And we bring that to bear to add value into the businesses that we invest in.
I'm curious as to what you think about just the whole business of investing in sports right now, which seems to have boomed. I know it's always been a thing, but obviously it's more accessible for a lot of folks in a way that it wasn't a few years ago. And of course, we've seen valuations, at least at the professional level, just skyrocket. I mean, you had a Lakers deal or one that's pending right now that values that team at $10 billion. That's insane.
It's a lot of money, and there's a lot of money in professional sports. The scale of it has really only been achieved to attract institutional capital interest in about the last decade, but the business of sport has been a big industry for decades at this point, and what makes it even more attractive to institutional investors is the fact that it's uncorrelated equity markets, it's recession resistant, it's proven that out over multiple dot-com bubbles, the 2007-8 financial crisis, and also with very strong and consistent secular tailwinds. The teams are an interesting way to capture those the revenue streams and that value creation. We look at everything. We've looked at hundreds of teams. We've looked at over 1,300 deals at this point, and 73% proprietary at last count. Been in 19 LOIs and invested in 7 deals, representing almost the entirety of our $300 million Fund 1.
Wow. So, but when you look at these big valuations, not just the level, the aggregate level, but really the pace of change from where they were just, the last time the sales had, do you see a potential for real return, a meaningful return on that higher valuation that people are buying into?
Yeah, historically, the team investments were somewhat more attached to like family office style investing or leaders of communities, business leaders within communities. Again, the scale of it has gotten so big, it's actually necessitated the involvement of institutional capital in order to aggregate that much capital. NFL teams, probably averaging 10 billion at this point or approaching that soon. But with the Lakers, a premier NBA team, if not the premier NBA team, setting that kind of a mark, institutional capital from a control position, it will be a good return. It's a great industry. It captures all the value streams within it. But from a minority position, it could be tough. They're illiquid assets that are not manageable from a minority position.
Well, that's what I'm curious about, the illiquidity of it. I mean, we know that the payoff being invested in a sports team can be enormous, but you usually have to wait a long time before you actually have that actual cash in the bank. I mean, it looks great on paper, but you can't spend it.
Absolutely. From an IRR perspective, maybe not the best way to maximize your returns, and that's what we're focused on, which is putting money to work, adding value, underwriting to true structured growth buyout returns with liquidity. We have exit rights in all of our deals.
Oh, really? And that's the primary strategy going forward that we're going to see out of Bluestone.
Quasi-control, absolutely. In addition to board seats, we have exit rights in our deals. We have an ability to help create value, again, tying to our experience and relationships in the industry.
All right, Bobby, what's your favorite sport, by the way?
Baseball.
Okay.
I'm a baseball romantic.
All right.
I've always loved baseball, but I've also been on the board of the USTA. I worked at the NBA for 10 years.
I saw that, yeah.
I'm a Renaissance sportsman.
Yeah, I definitely want to talk to you about tennis when we're out there. Bobby, great to have you. We got to leave it there. Bobby Sharma, founder and managing partner of Bluestone Equity Partners. When we come back, we're going to talk about the power of sustainable fashion. You don't want to miss this conversation. We're going to talk to the co-founder of Fair Harbor. You've seen those swim trucks everywhere. The founder joins us in just a minute. This is The Close on Bloomberg. All right, let's talk fast fashion, because a lot of those fast fashion makers are actually trying to leg into the sustainability race. Zara out with a line of clothes made from recycled fibers, H&M investing in wind energy. But our next guest, he's a pish posh. He's been doing that for a while on his own. His name's Jake Denny, and he's the CEO and co-founder of the swim trunk company Fair Harbor, and he joins us right now. Jake, great to have you.
Oh, great to be here. Thanks very much for having me.
All right, so you started this brand a few years ago with your sister. It's really taken off. Everybody's talking about it. We've seen all these great collabs you've had over the years. Focus in first on the sustainability nature of it and why you chose that path.
Yeah, so my sister Carol and I, we've actually been doing this for about 11 and a half years now. We started together when I was a junior in college, and she was a senior in high school. The company's called Fair Harbor. And when I was in college, I actually wrote a thesis on plastic waste, its effect on our oceans, our health, and our ecosystem. And at the same time, my sister Caroline had always been very much into fashion. She was in the climate marches when she was younger, and her bat mitzvah theme was actually sustainability. And so she was a perfect co-founder for me. And part of my studies actually found a mill converting plastic bottles into yarn. And so I turned to Caroline, and I'm like, it would be perfect to do something with this fiber. Let's make it into a board short. And we were inspired by our childhood summers spent in Fair Harbor, Fire Island, and so that's where the name came from.
Yeah, absolutely. And we talk about this idea of kind of a sort of a circular economy, if you will. I'm curious about your strategy in expanding. Are you primarily doing direct to consumer? Are you doing a lot of brick and mortar retail? How are you getting the product out there?
So at first, funny, when we started back in 2014, we sold all of our product through trunk shows. So it's actually me and Caroline throwing a bunch of product in the back of my Honda Pilot and driving up and down the East Coast and selling to anyone and everyone who would listen to our story. And so we did over 500 of those trunk shows. And then in 2017, we're like, we couldn't clone ourselves. Really, the only way to scale this business was let's figure out how to sell online. And so that's when we built our website and we started to learn how to market and advertise through Meta, Facebook at the time before it, was into Meta, and really scaled that business significantly. And then post-COVID, it's really been, all right, how can we get in front of our consumers? What is the best way to get in front of our customers, especially as advertising online gets more and more expensive? And so that's when we've really started to push into wholesale or selling through other retailers. And so we're in a bunch of national retailers, a bunch of mom and pop retailers, and that's been a huge focus for us at Fair Harbor.
And of course, we introduced you, of course, as a swimwear maker, but you guys have really evolved from that. You can get pretty much shirts, and as we were just showing there on the screen, shorts and other things as well. I assume you're going to continue to expand in that way, a variety of products. Is that true?
Definitely. So I think it was very helpful, especially at an early age of our company, to really focus. And so we focus on becoming the best men's swimwear producer in the market, and we sold millions and millions of swimsuits. But to really grow, we have to own more of our consumers' closet, and especially not just in H1, which is our primary season, in Q2 in particular, which is our summer market, but how can we really be relevant to our consumer for H2 in the back half of the year? And so that's where product expansion really comes into play. In addition, it's also very important for our wholesale partners so that we can stay on the floor all year long. As a swimmer company, you kind of come in and you come out, and so it's very, very important for us to have our presence throughout the entire year.
All right, Jake, got to leave it there. Really fascinating company. Jake Danahy, going from his Honda Pilot to the big time here, the co-founder and CEO of Fair Harbor. All right, that does it for us on the close.